What's going on YouTube? I'm your mentor Arkham Trades and welcome back to another video. And in this video, we're going to be talking about the candlestick anatomy plus the quarterly theory. This is something that is very hidden, that's not taught at all on YouTube, that I'm going to share with you guys today. And basically this is a full guide to algorithmic trading or trading like the algorithms. In this video, I keep it very simple. I explain what is candlestick anatomy as well as what is the quarterly theory and how we can pair those two together to create a mechanical strategy that we can come into the marketplace and look for every single day. Before we begin, make sure you guys click that like button. It only takes 2 seconds and it greatly supports the channel. Thank you. First, we have to uncover what is the candlestick anatomy theory. The candlestick anatomy theory is very simple. Every higher time frame candle is built from 3 phases within a lower time frame structure. First phase will be obviously the opening phase. This is where the candlestick obviously opens, referred to as our accumulation. And then we have our manipulation phase, right? This is when the market creates or establishes this low within the range, which is simply our distribution phase. Price is consistent of these 3 rules. We have the opening of the higher time frame candle, the manipulation, and then we have the distribution. Our main emphasis should be buying at or near the accumulation of that candlestick, or vice versa, at or above the manipulation for a bearish candlestick. After we've identified our higher time frame candle, now we can get down into our lower time frame structure, which is very simple. The lower time frames serve as a correlation with your higher time frame CAT range, right? This higher time frame candle, right? Let's say this is a daily candlestick. When we have a daily candlestick, we want to pay attention to the structure on the H1. H4 candle, we want to pay attention to the structure on the 15 minutes, H1 candle, M5 or M1, and obviously an M15 candle, 30 to 15 seconds, right? The higher time frame serves as a range and the lower time frames will give you your entry. So this higher time frame candle, let's say this was a 1 hour, we want to be looking at the opening to manipulation of this 1 hour candle. And on the lower time frames from the opening of that 1 hour, right, we want to be buying at or near these lower levels to obviously anticipate an expansion to the upside of this 1 hour candle. The lower time frames, after we've established this low followed by this breaker structure, right, this lower level here on the 1 hour time frame, right, let's say this is a 1 hour candle, this is now a strong low point, right? So price should not refer back to this 1 hour low. Instead, once we've already established this low and then we come back higher into the opening price of this 1 hour candle, price should remain at or above the opening price for the distribution. And this gets us into our H1 model, right? The main emphasis is to focus on the H1 time frame. Specifically, the macro times that I prefer the best is 10 a.m. candle to the 11 a.m. candle. So this opening price is either the 10 a.m. candle or the 11 a.m. candle. When candle opens up, I want to establish either a high or low in the CAT range within a point of interest. And that point of interest can be either a liquidity pool, fair value gap, or order block. After we get this 10 a.m. open and then we see this drop lower, we want to see it drop into one of these 3 things. And then after establishing this low and then getting this lower time frame breaker structure away from it, this is now a protected low, right? This low of that 1 hour candle is now a protected low, and obviously we can anticipate higher prices, right? This would be referred to as our H1 model. Now that we've identified the candlestick anatomy theory in our H1 model, we can go into the quarters theory, right? The quarters theory is very simple. It simply states that every 15 minutes within a 1 hour candle is a macro, where every 15 minutes price will create a fair value gap to use as an expansion. So obviously we have this opening price here at 10 a.m., right? This is that 1 hour candle, that 10 a.m. opening, and then we see this drop low. This manipulation should tap into a point of interest, right? After tapping into this point of interest, we see this push to the upside because every single candle right here is 15 minutes, right? 15, 15, 15, 15, 4 15-minute candles create a 1 hour candle, right? Within this 15-minute candle right here on the lower time frames, like the M5 or the M1, price will create a fair value gap. And as you can see, the next 15-minute candlestick opens up, comes lower into that fair value gap to find support to push higher. Same thing right here. Next 15-minute candlestick opens up, comes within that prior 15-minute candlestick to find support to push higher. But obviously not every single fair value gap works. Only the fair value gaps during the distribution phase after price has already established a low or a high during the manipulation phase, as well as the entry could be either a fair value gap or an inversion fair value gap. So we've identified our higher time frame point of interest down here. Price comes lower, right into this level, and then we see this. Let's say there was an inversion fair value gap down here. This would be your first entry right here, the fair value gap right here. So if you missed this entry, there was a fair value gap right here, or whether you missed this entry, there was a fair value gap up here at this third candlestick, reaching back above higher prices for that distribution. When you understand the 1 hour manipulation plus the distribution, it becomes very simple. This is simply just a buy model. Price came lower for that manipulation. After establishing this low, price is now in a buy model respecting bullish fair value gaps. So you can trust when price comes down into a fair value gap, either on the 5 minutes, 1 minute, or even the seconds time frame, trust that to be a support level, and the algorithm is going to respect that fair value gap to obviously reach back above higher prices. This would be a buy macro second leg manipulation. This first candle will be used as an accumulation, and then the next candlestick will come lower, tapping into that fair value gap, order block, or liquidity pool, and then finding support here, right? Within this prior long candlestick's wick, price will create an inversion fair value gap, right? Within this wick level, price will create an inversion fair value gap, which, as you can see, the next candlestick on the 15-minute opens up, comes within that prior wick here, right? Comes into that fair value gap or inversion fair value gap within this wick level to find support to push higher. And then by macro, third leg manipulation. We can see we had this original accumulation, this accumulation again, and then price finally comes lower to tap into that higher time frame point of interest, giving this long wick inside the marketplace. Whether price creates the low inside of that manipulation within the first candle, second, or third candle, it's very important after getting that manipulation. So essentially we see this push higher. We can see price closing back higher, back above these last down close candles. This is a change in state of delivery. So within this 15-minute candlestick, price will create a fair value gap, which, as we can see, price comes into that fair value gap right here to find support to push higher. Trading plan is very simple, right? We want to be trading either the 10 a.m. or the 11 a.m. candle during the New York, or 2 a.m. to 3 a.m. candle if you're trading London. You want to be observing the H1 and M15 timeframes next to you. You always want to be observing the H1 and M15 timeframes, obviously. And then you want to anticipate price to create a manipulation either lower or higher into a higher time frame point of interest, right? We talked about this, the liquidity pool, fair value gap, or order block on the H1 or M15. After price has established the manipulation following a break of structure, H1 high is not protected and price should not come back above it. Just like we mentioned, when price has already came lower, find support inside this fair value gap level, and then seeing this break higher, price should not come back below this level. So you can trust that any fair value gaps within this range, price is going to support it to go higher, as well as the entry within a fair value gap must be on the 5 minutes, the 1 minute, or even the seconds time frame. And if you don't have the seconds time frame, that's totally fine. You can just use the 1 minute. Now let's hop on the charts. And if you guys want access to today's PDF plus trading plan, I will be putting it inside of the Spark Train community for completely free. All you gotta do is click the first link in the description, join the Spark Train community, scroll all the way down here into the PDF section, and you guys can grab a copy for yourselves to look at, backtest, and much more. That's gonna be a first link in the description. Now back to the video. Now that we're on the charts, I'm going to be breaking down this trade that we took this morning. As you can see on my Instagram, I took this trade about 6 hours ago, and it made me a little over $4,000 across some of my funded accounts using the exact same analogy that I just taught you, the candlestick anatomy theory plus the quarterly theory, right? It works every single day, and I'm able to profit like this every single day. As you can see here, we framed our entry at the low of that 1 hour low. I'm going to be breaking down exactly what I seen, how I framed the daily bias, as well as how I was able to get the perfect entry, as well as the perfect exits, because this ended up being the exact high. 30 minutes before that 10 a.m. opening price, you want to frame your overall bias, and it's very simple creating a bias. All you have to do is mark out your liquidity pools, higher time frame points of interest, and just be patient. Wait for price to come into your zone, wait for that reaction, wait for that manipulation, and then catch the distribution. I'm on the 1 hour time frame here, and some key things I can take note of is obviously we do have this liquidity pool. Price came lower, swept this level of liquidity, and then around 9 a.m. we saw this push to the upside. So obviously we can see that price has some momentum to it. We took out this liquidity pool, and then we saw this push higher. This is very good. As well as we do have points of liquidity above us, we have these Asia session highs. The Asia session is between 8 p.m. to 12 a.m. EST. Got these Asia highs here as a level of liquidity. Price usually comes to the Asia session highs or lows basically every single day. It's a very algorithmic area that price loves to see. As well as we can identify this area of inefficiency, we have the separation here where price created no bodies, right? This would be referred to as a volume imbalance. We have a liquidity pool above us, as well as we have levels of inefficiencies above us as well. When creating a daily bias, it's as simple as that. We came down to a level of liquidity and we seen a push higher, and we have levels of draw on liquidity above us. We have this liquidity pool, these Asia session highs. Price usually almost always goes to the Asia session highs and lows. So this is an easy area of liquidity that price will then target. As well as we have this volume imbalance. Price has to come back into this level to rebalance. Based upon that 10 a.m. opening, I want to see the market open up, create lower prices, and then from those lower prices, I want to catch that manipulation, reaching back up into these Asia session highs, and obviously back above this volume imbalance. Potentially, if price will, reaching back up into these previous daily highs. Very, very simple. Now I'm gonna go down to a 5 minutes time frame because the 10 a.m. is just about to open up. This right here would be the 15 minutes. So every single time that price opens up and creates a 15-minute candle, it's going to be displayed on my right, as well as this is the 1 hour candle, which is also displayed on my right here. As the next 1 hour candlestick opens up here, I want to see price open up, come lower to establish a manipulation to where I could frame my entry, reaching back above higher prices. Price can create some type of fair value gap or inversion fair value gap. I will use that as my entry, targeting back above these draws on liquidity. You can identify this fair value gap right here. It's very important to note that you can use fair value gaps that price has already created before 10 o'clock, but you have to take the trade within 10 o'clock. As the 10 o'clock opens up, I want to see us open up, come lower into this fair value gap level to find some type of support to push higher. We can see 10 o'clock opened up. We saw this drop lower here. This comes out into this fair value gap. I can frame my long entry, my stop loss back below this fair value gap low, right? The fair value gap is this 3 candlestick formation from this first, second, and third candle. Down here is where your stop loss should be and where you should feel the safest at the low of that fair value gap. Target reaching back up into that volume bounce here. This would give me a 2 to 1 R. My stop loss would be a little bit wider to take into account any drawdown. You don't want to be in a position to where you have a tight stop loss. You always want to let your trades breathe, and then once price establishes that low on the 1 hour, then you can adjust your stop loss. So I want to see how does this trade play out. Price comes lower once again within that fair value gap, and then we see this push higher. This would be classified as the prior 15-minute candle right here. This is that prior 15-minute candle. On the 1 hour time frame, we can see here that price opened up, came lower, established that low, and now we're back above the opening price. This is a position to where I may feel comfortable putting my stop loss back at the low of the 1 hour, because obviously this was a point of interest right here, this fair value gap range. See, price had already found support here and broken structures to the upside. So obviously this is a strong point inside the marketplace that price is not going to break. Now I can go down to a 1 minute time frame and see if I could get a 1 minute fair value gap to potentially scale in. On the 1 minute time frame here, I can identify this inversion fair value gap right here. So if we can see price come back into this inversion level, I could potentially scale into my position. This is the next 15-minute open, right? So we have this prior 15 minutes here at around 10 o'clock where price opened up, saw this drop lower into that fair value gap and saw this push higher. Now we have the next stage accumulation within the next 15 minutes. So I could scale into my position right here, adjusting my stop loss back below this prior 15-minute low, reaching back up into those same levels, basically maximizing my overall reward. Unfortunately, price does not come back within that inversion level, and it unfortunately leaves us. But as we can see here, price does create a fair value gap right here, which we can see price does slightly tap up into. Missed our entry here inside this inversion level. That's totally fine. We can take our new position right here, stop loss just back below this fair value gap low here, and I could put my original trade back to break even. Let's see how this plays out. And as we can see, price comes back into that volume bounce there. First trade right here within that first 15-minute candle. We came into that 5-minute fair value gap, found support to push higher, and at this area price created this inversion here. Price did not tap into that inversion, so I ended up missing my entry. Even though I was looking at the inversion, price did create this small little fair value gap right here. Price did tap up into, as well as there was an inversion up here. Just chose to get this inversion level because it gave me a better risk to reward. Even though I missed this inversion at this low here, I still ended up getting this fair value gap trade right here within the third leg. A hourly candle is built upon 4 15-minute time frames. This would be that 10:30 to 10:45 candle, which we can see price came down into that fair value gap level and then seeing this rise higher, reaching all the way back up into that volume imbalance. Put the stop loss just back below the low of this fair value gap level, and seeing how price respected this fair value gap here, by seeing how price is respecting it, and it came down into it once again, right? These are small algorithmic signatures inside the markets, so obviously reaching back above higher prices. This is the exact trade that we took this morning using the exact same framework that I just taught you. In this channel, I not only teach you these lessons, but I also use them myself as I am a full-time day trader. Make sure when you guys are watching these videos and you guys are learning, make sure you guys are taking notes and implementing it and backtesting it and using it for yourselves, because I use it myself and I make a lot of money trading. And like I mentioned, if you guys do want the free PDF plus the training plan, I will be putting it for free inside the Spark Train community. You guys can just click the first in the description, join the Spark Train community, scroll all the way down past the free courses, the ebooks, and much more. And then you guys can click the PDF and then download it for completely free, backtest it yourself, learn and implement it into your own trading, and hopefully make your first $10,000. But before you leave, make sure you guys leave a like, comment what you guys want to see next. I'm your mentor, Trades. Be safe.